Good morning. It's Wednesday, the 8th of May, and this is Govindraj Ethiraj, broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Our top stories and themes for the day. Market volatility in the Indian stock markets is increasing. What should investors do? Why the last 15 years of stock picking strategies may not work today. India's growing number of ghost malls. Growth versus load. Why some bank systems are failing.
This is a core report with Govindraj Ethiraj.
Stock markets fall, but volatility inches higher. The stock markets ended lower on Tuesday, with volatility rising to a 15-month high amidst the ongoing national elections. The Nifty Volatility Index, a gauge for domestic market volatility, rose for the 9th consecutive session to close at around 17, which is a 15-month high, according to Reuters. Now, this is up more than 70% from April, that's last month's lows. So the rising volatility is not unexpected in itself and perhaps only demonstrates that all election periods are embedded with some uncertainty, however sure market participants are of the outcome. Also, if you go by the benchmark index numbers, the markets are broadly steady, but obviously the derivatives position reflect the uncertainty which is rising. So the BSE Sensex fell about 384 points to end at 73,512, and the Nifty 50 ended down 140 points to close at 22,303. So the broader markets lost more, with the BSE mid-cap and small-cap indices falling between 1.9 and 1.6% respectively. Foreign institutional investors are also selling close to about 1,000 crore rupees in 3 trading sessions in May, according to the Mint, quoting NSDL data. G. Chokalingam, founder and head of research at Economics Research, told Mint that FIIs, or foreign institutional investors, have been continuously selling, which has caused nervousness amongst domestic retail investors as well, adding that they generally don't buy before general elections. According to him, they wait for the election outcome, and even if they have to pay a premium, they would buy later. And he says he's observed this over the last 2 decades. Meanwhile, and interestingly, total securities owned by sovereign wealth funds in India has gone up by about 60% in the 1 year ended April 2024 to touch about 4.7 lakh crore rupees, according to Money Control, quoting data again compiled from the NSDL, which, by the way, is the National Securities Depository Limited. Some of the big sovereign funds include the Government of Singapore, Abu Dhabi Investment Authority, Kuwait Investment Authority, and the Norwegian Pension Fund. The Government of Singapore's biggest investments in Indian stock markets are in companies like Reliance Industries, where it owns about 1.5%, worth about 30,000 crore rupees at current market prices. It also owned about 2.3%, or shares worth about 25,000 crore rupees in HDFC Bank, quoted Money Control. In the last 5 years, the government, that's the Indian government, has eased the compliance process for such funds, which is the sovereign funds, and also provided special tax exemptions for certain sovereign wealth funds, such as the Abu Dhabi Investment Authority, according to Money Control. Elsewhere, in oil, prices were steady on Tuesday, thanks mostly to a weakness in the physical market, which offset concerns about a conflict in the Middle East as a ceasefire deal between Hamas and Israel hung in the balance, according to Reuters. Brent crude futures were down 30 cents at $83 a barrel. Oil brokers told Reuters that even if there was a truce, there was still a question on whether Houthi hostilities in the Red Sea would cease and the Suez Canal would reopen, reducing risks or potentially reducing the risks of shipping in the region. Why stock picking strategies of the last 15 years may not work. Fund manager and investor Jyotivardhan Jaipuria told me in a long conversation a few weeks ago how his funds had decided to focus on the investment theme as opposed to the consumption theme in recent years. Now, this strategy has obviously paid off because stocks linked to investment themes like infrastructure and real estate have done well. In a column in Business Standard that appeared a day ago, another veteran India investor, Akash Prakash, says that the markets are clearly signaling from its price action and sectoral leadership that we are back towards a scenario reminiscent of 2003 to 2008, where the bull phase was led by capex-heavy sectors like infrastructure and real estate and investment-driven sectors. Now, that of course is similar to today. The market then was more focused on revenue growth than returns on capital and free cash flow, and the so-called quality universe of long-term compounders lagged the markets. Now, this period was the last time quality compounders were actually cheap in India. Investors were chasing growth at any price and capital investment was greeted with cheers from the markets. But then, says Akash Prakash, post the global financial crisis, the market's drivers of performance reversed. From 2009 onwards until very recently, we saw the era of the quality compounder. Quality stocks, typically consumer-facing with high returns on capital, stable and predictable growth in both revenue and earnings, and with a good industry structure, performed incredibly well. So this would mean, and this is not Akash Prakash's words, but mine, stocks like Hindustan Lever or HDFC Bank or broader bank and consumer product stocks amongst others. Now this, to go back to what he says, was the era of consumer stocks and plays on formalization. Moreover, while these stocks delivered reasonable earnings in the 15 to 20% range, they also had strong multiple expansion which supercharged their performance. The multiple expansion phase, now he says, seems to have ended and we appear to be in the midst of a period of multiple normalization for the quality universe. As their multiples compress, these stocks have been mostly treading water with limited price appreciation over the past 18 months. Similarly, he says, the markets have seen value migration from PSU stocks to their private sector competitors, and this was most visible in the PSU private bank trade, but was also seen in telecom, insurance, and aviation. Now, this trend is also now reversing. PSU stocks are now trading at multiples above their private peers in some sectors and have delivered a huge return alpha over the past 18 to 24 months. Markets seem to believe that the PSUs can now keep their current market share and have better productivity and profitability. They continue to have scope for operational improvements. So what's the message? The basic message, Akash Prakash says, is that the portfolio construct that made one successful over the last 15 years has been underperforming for some time and is likely to continue to do so until there is a full reset of multiples within the quality universe. So, portfolio managers who have cut their teeth in the last 15 years have by and large only seen the quality trade work. So if you were not there in 2003-8, you've not seen the opposite or the antithesis of quality driving markets. The market action is quite clear. Leadership has changed and we are unlikely to go back to the old dynamic anytime soon, says Prakash. Moreover, anyone investing over the last 15 years has largely made their money back in quality at almost any price and avoiding PSU stocks and asset-intensive businesses like the plague. This strategy, says Prakash, is unlikely to work in the current bull market setup with mid-caps, PSUs and stocks benefiting from the investment cycle leading the charge. So what should an investor do? Forget the investment philosophy and latch on to what's working? Dump their quality stocks and buy manufacturing or the investment theme? Or should you move in the opposite direction? Now, there is no clear answer here, and I won't borrow further from Prakash, but it's useful to know that veteran fund managers also struggle with these issues. Jaipuria, in my conversation, echoed the same thought, though differently. He said his team was constantly evaluating getting back into IT stocks because they'd been beaten down for precisely some of the reasons we spoke of earlier, but then was unable to make up their minds. India's ghost shopping centers. India's small malls are increasingly turning into ghost malls as consumers move towards online purchases and bigger shopping centers for a better experience, a report from real estate consulting firm Knight Frank has said, and reported by Reuters. Ghost malls or vacant spaces jumped 60% in 2023, and mall properties with a vacancy rate of more than 40% are called ghost malls. Areas available for lease in all shopping centers grew roughly 2.5 times in major Indian markets in 2023, but the number of ghost malls went up from 57 to 64, according to the Think India, Think Retail 2024 report released by Knight Frank, which studied about 340 shopping centers and 58 high streets in 29 Indian cities. According to that report, roughly 6,700 crore rupees or about $800 million is lost or trapped in the gross leasable space of these non-performing shopping centers. The largest inventory of ghost shopping centers was in the Delhi National Capital Region, followed by Mumbai and Bangalore. The report said, however, overall shopping center vacancy in 8 major Indian cities improved, indicating a rising demand for retail. Why are bank IT systems failing or unable to cope with the load? A few weeks ago, the Reserve Bank of India asked Kotak Bank to stop issuing fresh credit cards and stop onboarding customers digitally. The reason broadly was that its IT systems were failing to work smoothly and were collapsing. Other banks have faced similar problems even as they go for rapid growth and scale using technology. HDFC Bank, for example, was asked to halt new card issuances 4 years ago as well, following repeated outages in its data center. Full operations were only restored or given back 2 years later. There is no doubt several banks are facing this issue. From my own conversations with chief information officers in banks and in the context of growth of payment systems like the UPI, which places unprecedented strain on what is called the bank's core banking system. So where is this pressure coming from, and where is it felt most within banks, and why are banks unable to keep up with the challenges of growth and targets they set for themselves? I spoke with Kunal Pande, National Co-Head for Digital Risk and Cyber and National Leader for Digital Trust Financial Services at KPMG, the consulting firm. He's also part of the KPMG International's Global Payments Leadership Group. And I began by asking him for a general background on a bank's IT systems and how it's purposed in terms of what activities it caters to before coming to where the load was really coming in.
So when you look at a bank and the core banking within a bank, with one lens, one can say that core banking takes care of the deposits, takes care of the lending, takes care of a number of things which are called transaction banking, which is like cash management, payment, trade, etc. These are the things which typically, are referred to when one, talks about core banking. A bank also has certain other systems, treasury system for treasury management, which could be investments, raising funds, etc. from the money market. Then, of course, it has systems like risk management, fraud management, compliance. Then certain services which are more, I would say, nuanced. For example, wealth management, where for a high net worth individual, it will be a combination of deposits, lending, and certain other, services which will be provided. And then, of course, for all these services, if you think of a digital mode, then there are channels through which these services are availed by the customers or used by the bank's own staff to offer services to the customers. And there is also reporting, where lots of reports, whether it is customer report, whether it is internal report, whether it is regulatory report, a lot of those are, generated. So that's one way of looking at the core banking plus as a technology environment in a bank, which is more, I would say, is a business or a functional view. One can also think of a technical view where typically in today's arena, you would find that the systems are organized in 3 tiers. So there is a tier which is more end facing towards the customer, handling the interactions, handling the presentation layer, etc., which is typically in a traditional world is called the presentation layer or a web interface. Then there is a business layer where functionality, etc., is coded, which is called application layer. And there is a layer where data is handled, and there are specialized softwares like database management systems which handle data, so which is called the database layer. So 3-tier architecture of a web or a presentation layer, business or an application layer, and a database layer. So I would say reasonable simplicity. This is how I will describe the banking environment.
Right. Now, in some of the cases that we've seen recently, clearly the strain on the system is rising or has risen so much that there is a denial of service to customers, or let's say in the case of transactions, when transactions happen between two parties. So at what point is the system breaking?
I would say let's take a step back to understand what system is and how it works. So typically, what is system? There are a set of components, right, which come together and deliver a particular service. Now, all these components were designed for a type of use case scenario, which before UPI really went through the roof, if you think of, and before the digital channels became the primary channels and branch became an add-on. So, even if I go 10 years back, people will say branch is the main, digital channels are an add-on. But now the role has reversed. I was talking to one of my friends yesterday, and he was telling me that for last 5 years, he has never visited a branch. He has never visited even an ATM, right? And I would say probably you and I will not be very far off from that category. Not 5 years, we don't visit, right? So the purpose for which the technology is being used has changed significantly over the last, you could say, even 5 years itself. Now, technology is not a very simple thing to implement. It takes time and effort to implement. It's a cost. So the technology environment in many organizations has been designed for a setup which was, you can say, few years earlier setup. And we're seeing a sea change there. Because of that, certain components, which were not designed for this kind of a scale are under strain. So, for example, core banking system itself, it's a system, as I said earlier, handles deposits, handles lending, handles some of the transaction banking. Everything has been, put together in one system. In certain banks, it has been divided also. But these systems are not designed to handle micro transactions. When I say micro in terms of the value, which are coming in enormous velocity. So, the response time of these systems are sometimes not aligned to that, because these systems are not just responding to such microtransactions. They're also responding to people who go to branch. Somebody who wants to avail a loan, a complex loan processing might be, going on in the system. So these are not designed for this. And that is where we are seeing sometimes the challenges come in. Challenges may not always be in terms of system is down. It is many times the response time is slow. Now, any environment, right? Let's say when you and I are talking, if there is a long pause, you will start asking me, am I there or not? And maybe after some time, you will terminate and restart the call. Systems are also designed the same way. So if nothing happens, they restart. And there you go, a transaction fails because, customer will not wait. Customer will experience that the transaction is not working and, the systems are down. So that is where we are seeing sometimes one finds that few transactions are failing. Sometimes for short periods of time, a large number of transactions fail because some of these systems are not designed. Having said that, if I see over the last now few years, significant changes are happening in the banking environment. A couple of years back, we had more instances of certain transaction timeouts. Now it is slightly lower. Nevertheless, we are still seeing it because on one side, while systems are becoming better in handling, the transactions are still growing in a enormous velocity. So it's like, you build for something tomorrow, but by the time you build, tomorrow has already been passed. Right? So that's the scenario in which one has to handle. And therefore, more flexibility is needed to make sure that the systems are also nimble where they can scale up as the things are required. And there, if I could just end with one more point, is in certain organizations, banks, there is a approach which is being taken where interactions with the customer, if you're using your app and you want to know your balance is just a number which is coming in. But then there is a whole set of other things about how the balance is presented to you in your screen. There is a font size, there is a place where it comes in, there are certain other information which is displayed. So the interaction is made much more richer, keeping in mind what you might be thinking of doing subsequently and also making your experience really good. So there is an effort to decouple most of these into a front-end system, which could be on a cloud or much more agile setup, and reducing the load on the core banking. And there are newer methods which are coming in where there are talks about can microtransactions be completely made away from core banking so that, the core banking does its job, which it is designed to do best. And some of these newer things are handled in a differentiated strategy. So this journey is currently, I would say, on in organization. It's like a point about, how soon you can become better. And if in that meantime, some specific load comes in or something happens, then you try and deal with it in whichever way best one can.
One of the problems clearly seems to be that the growth has been very fast, as in banks have clearly gone after, let's say, more customers through the digital route. And perhaps that's led to the point which they maybe did not anticipate of a load level which the systems could not handle. So, what would be the way out, at least at this point? I mean, how should banks then be handling growth and load in a way that, let's say, their existing customers feel that, things are not going to collapse?
Sure. I think before I answer that, I just want to, highlight one more point. Unlike yesterday, today's banking is not being offered by banks alone. So, for example, if you go for a loan, your KYC is done through Aadhaar, your further verifications are done through PAN site. If you are self-employed, some of your financial behaviors, those data is picked up from GST or maybe from Vahan site. And there are certain, other third parties who provide other data, whether let's say a bank account related data, etc., etc. The bureaus provide the credit information. So there are lots of these third party systems. Again, all of them have to come together. To succeed, everything has to work. For failure, even if one fails, there's a failure. So one is about all these in third parties. Two is the entire capability which bank built, which is around the integration. So whether you call it, enterprise service bus, or in newer ways, microservices architecture or API capability. So a lot of these again have to work together in a seamless manner to deliver the end result. It's the bank, the way the customers are now interact with bank in the digital environment, as we discussed, plus these third parties. So now coming to your question about, what is needed really to handle. One, I would say, is when we are working in an environment which is complex, which needs very, very high throughput, very low response time, it's very important that everything is really well oiled and modular in nature so that one, things work fast. Two, if something goes wrong, you know where something has gone wrong very quickly and you have an ability to fix it very fast, which means that the architecture in the way in which the systems have been designed, they are done in a very, very robust manner, keeping in mind the current use and the future use requirements. So the architecture has to be flexible as well as resilient. Architecture needs to provide for the observability or symptoms of what's happening. Maybe not the best example. Let's say if I'm flying a aircraft today, there are so many indicators which keep giving red or yellow or red signals, which are telling the pilot as well as the engineering staff what's the health of each component. So that if anything is likely to go wrong, it can be identified early enough before the users, whether it's customers or the bank staff, can feel the pinch. It can be identified earlier and then remediation can be done. So that's called observability. So observability of the various components have to really go up so that one can diagnose this faster than before some material or noticeable impact is coming on the service deliveries. That is something which has to be done. Of course, in cybersecurity aspects, systems have to be built really secured. And last but not the least is monitoring. Because while I may have best of things, but if somebody is not monitoring it and is able to take quick response action, it will not really help. So again, to recap, first, the architecture has to be flexible and resilient so that, we can adapt to the change faster and it can be resilient towards some minor glitches. Observability in the system has to be really high so that I can early identify if anything is going wrong and I can take remediation action. Security has to be really high given the current environment, and monitoring and response capability has to be high so that anything is going wrong, minor or major, one can identify it as soon as possible and address it quickly so that the impact is either not noticeable at all or it is minimized completely. Those will be the four, key points I will highlight.
Right. Kunal, thank you so much for joining me.
Thank you. Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.